Hello, everyone, and welcome to the Buck Stops here. I'm Catherine Murray. I feel like I'm saying this every week, but we do continue to see very volatile markets and markets that continue to trend lower. Specifically, of course, the driver this week is what we heard from U.S. Fed Chair Jerome Powell yesterday, raising rates by 75 basis points. That was expected, but perhaps the hawkish tone was not as expected as obviously the market was pricing in because the market was down by about 1% and continues to trade quite mixed today. I of course, do pre-tape this to get some perspective for you in terms of where we think the market might be going, how to position yourself. Is the Fed going to go too far, too fast, and cause a hard landing? Those are all the commentary that is occurring right now. Let me bring in Dave Burrows. He is the president and chief investment strategist at Barometer Capital, a face and a firm that I think is quite familiar to many of you. David, great to be with you today, and thanks so much for joining us.
It's great to see you, Catherine.
Thank you. I think we really have to start with what we heard from the U.S. Fed yesterday. Obviously, reiterating what he said at Jackson Hole continues to somehow surprise the markets. How are you interpreting where the Fed is and what you think they're actually going to be doing and the impact that will have?
Right. Well, you really sometimes have to separate the words from the actions. They've been pretty clear about what their plan is, which is to tighten financial conditions. They made it clear early on they wanted to front load the action because they felt they had a pretty strong economy to work against. They felt they needed to work fairly quickly. And they want to use all the tools that they have, including the bully pulpit. So they have an opportunity when they do these meetings to vocalize what they would like to see happen. And whether or not they follow all the way through on the things they're talking about, they're trying to make sure that people understand that there are tighter financial conditions coming. That may just in itself cause people to hold back from consumption, hold back CEOs from major investment, and help the supply chain to catch up and try and tamp down some of the early pressures on wages.
So do you think then it is the right move? I mean, so many times when we've seen federal chairs raise rates, they so often cause recessions. We know that Fed Chair Jerome Powell is a fan of Paul Volcker going back to the 70s and the recession that ensued. Hard landing, a very hard landing. We've got a hot housing market here in Canada. I mean, how much risk is there that they're going to raise rates far too aggressively and really cause a lot of pain in the broader economy that will last longer than anticipated?
Well, you have to remember that only a few months ago they were saying we aren't even thinking about raising rates. And as the data changed, they had to change their tune. So I think in some ways they're embarrassed that they are behind the curve. As Stanley Druckenmiller described last week at a meeting I was in, that they're like reformed smokers. Not only have they quit smoking, but they want to talk about it all the time. And the reality is that they are behind the curve, and so they've tried to tighten quite quickly. But they're going to remain data dependent. And if the data really starts to slow, their tune can change fairly quickly. But in the short run, they don't see that as the risk because the employment market is so strong. They want to try and get out in front of this.
Right. I mean, in many ways, it does make sense. But at the same time, too, I think that a lot of people have lost faith in the Fed because, as you say, they weren't even thinking about raising rates. And now they're playing catch up. And now the concern, of course, is that they're going to go too far. I mean, you look at the fixed income market today, it's pretty astounding that the U.S. 10-year yield is 3.6%, the 2 years at 4.1%. I mean, the fixed income market, they're supposed to be the smartest guys and girls in the room, they're concerned that there's going to be a hard landing.
Yeah. Well, there's no question that we went through a very significant regime change, starting in 2020. And, it's strange for us. We've really avoided any kind of fixed income over the last 2 years. And actually, we're short fixed income for quite some time. And the problem for investors is that their experiences have all been in the last 40 years during relatively falling rates. And it's just not the case today. And so it really calls into question all of the things that they believe work from an investment standpoint, and really have to reconsider the way they've structured their portfolios.
Absolutely. Let's take a quick break. When we come back, we'll talk about some of the themes that you and your team are thinking about and employing for your clients' portfolios, and also to rethink what we think works now and what might work over the next 2 to 5 years. We'll be right back.